Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Covered Calls and Short Puts. And today we're going to that topic of covered calls. We're talking about 5 ways a trader or an investor might reduce the odds of getting called out. Sometimes we're selling covered calls, but we'd really prefer to hold on to the shares if possible. Well, we're going to be talking through the pros and cons of 5 steps that might be taken proactively to try to mitigate that risk. And then we're going to be planning and place an example trade today. So it's going to be a lot to cover. Before we get to that, though, let me first of all say hello to everybody who's already chatting in. Great to see all the familiar names. Hello to anybody that's new. But hello there, Tony, Will, Scott, Mark, Lawrence, Eva. Who else is here? Let me scroll up a little bit. We have Lakshmi, hello, and Jackson, and everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you are here for the very first time, welcome. Great to have you on board. And if you're watching on the YouTube archive after the live stream is concluded, we'll enjoy the recording. It's a great way to watch these webcasts, but you're certainly invited to join us in the live stream. This is a Monday webcast series, and we kick things off promptly at 2 Eastern time. Love to have you here. Now, also want to let you know that my very good friend, Barb Armstrong, is hanging out in the chats with us. She's going to be addressing any questions that I can't get to just during the flow of the presentation. I see that Barb's already been active in there chatting with attendees. Thanks for having my back there, Barb. Barb and I would also like to issue an invitation to everybody watching to follow your favorite Schwab presenters on social media. So for example, you can find Barb and me on X. Find Barb there at Barb Armstrong CS on X. You can find me on X at Cameron May CS. You can also pop over to LinkedIn, go to linkedin.com/in and then /Cameron May CS. Give me a follow there. But let's get into this discussion. And as we do, of course, covered calls and short puts and other approaches to investing and trading carry risks, so be aware of this important risk information. Options carry a high level of risk and are not suitable for all investors. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so with that accomplished, let's set the agenda for today's discussion. I do want to take a very quick peek at what's going on with the markets. Not going to spend much time on that at all, but just to give a little bit of context for the sort of conditions that a covered call or a short put seller might be contending with at the moment. Then we're going to switch gears. We're going to go prepare to sell a covered call on an existing stock position in our paper money portfolio. But as we do that, we're going to take steps both at the front end of the trade to try to mitigate the likelihood of assignment. And also, we're going to make plans, plans for the management of the trade that might assist with reducing the risk of getting called out. So let's go right to the Thinkorswim Paper Money desktop platform. Here's the S&P 500, and the S&P has been trying to work its way higher. Obviously, we've gotten a little bit more chatter, more of a sideways behavior over the last couple of months, and recently pulling back. But if we look at what's going on with the S&P today, we might see that it seems to still be making higher lows, which for some might indicate continued bullishness. Plus, we're having a pretty good day today, bouncing off what appears to be a price floor, up about 1.1% on S&P 500 company stocks on average. And so let's just say that our outlook for the foreseeable future is still bullish. Obviously, that's not guaranteed, but that is fairly cooperative with a covered call or a short put, both of which are bullish income strategies. So let's go start to piece together a covered call position for our example paper money portfolio. So I'm going to go over to here to the monitor tab. Now, if you were to go back to last week's discussion, you know that we had CAH in this covered calls and short puts field already, or what we call a group on the Thinkorswim monitor page. But I've moved up Alphabet or Google from the unallocated portion of our portfolio. There were 100 shares that were just sort of sitting there doing nothing. I decided to move those up. Let's sell a covered call on those. So that's where those shares came from at original purchase price of $304.84. So let's put ourselves in the shoes of that theoretical Alphabet shareholder, and let's go see if we might be able to generate some potential income from this position. So I'm going to pop over here to the charts tab, and it looks like we're new here. Oh, yeah, yep. Great to see somebody. They say, how can I join the fun without feeling lost and disconnected? So I do try to bring everybody up to speed. That's why I was explaining where those shares come from. And I always try to go at a pace that everybody can follow. But I definitely do have a suggestion for anybody that's brand new to options. If you have no idea what in the world's going on, what I would suggest you do is watch this webcast, continue right on through. That's okay. I'll try to explain as I go. But if you really want to learn options right from scratch, here's my suggestion for you. First of all, make sure that you're subscribed to our Trader Talks channel on YouTube. So the full name of the channel is Trader Talks Schwab Coaching Webcasts. You just do that by popping down below the video right now. Click on the subscribe button. That only takes a second, doesn't cost anything to do that. But our channel is where you can join live streams like this one, or very importantly, you can go back to previous webcasts that have been grouped into what we call playlists. And I actually have a playlist that was it's a series of webcasts that I put together specifically for those that are new to options. So if I go to playlists, if we scroll down just a little bit, what you're going to be looking for is right here where it says start here to learn about trading options. And there's a short playlist of 10 videos that I made that just go through step by step through what I call building blocks to learn how to trade options. All right. So there we go. You click on view full playlist. There they are, lesson 1, lesson 2, lesson 3, and just go through those. All right. But back to our example trade today. Let's switch our chart over here. And also for those that are new, the software that I'm using for this demonstration, this trading platform, it's known as Thinkorswim. It can be downloaded free of charge from within your Schwab online account. You'll just go to the Trade tab and then look for the keyword Thinkorswim. Click on that and it'll walk you through a process for downloading Thinkorswim. And then you just log into this software that you've downloaded with your Schwab credentials. No special username or password, just use the same ones for that you use for Schwab. But in any case, so here's what's going on with Alphabet. Let's say that our shareholder here, they own some shares, bought it back when it was 0.05. Now it's about 353, and it's actually been higher, been pulling back from price highs, and it's come down to what appears to be a potential price floor. If you'll notice, this level of about 340 acted as a pretty good price ceiling for about 5 months. We finally pushed up and through that, and now it may be acting as a new price floor. Time will tell, but let's just say that our trader here thinks, okay, looks like price might go up a bit, but maybe they think we're going to run into another ceiling. So what we're going to try to do is get a little blend of, let's say our ceiling looks like it's, I don't know, could be, should we just sort of slap it in there about 375-ish? How's that work? That'll work. Right around there. But let's say that our trader is hoping to make money as price goes up to 375, and then they want to throw on a little dash of income through a covered call. If you're not familiar with a covered call, it means that we're giving someone else, we're selling someone else the right, requiring them to pay us, but in exchange, they're going to have the right to buy our shares from us for a prescribed price for a prescribed period of time. It is a contract. It's known as an option. They have the option to buy our shares if they want them. So let's just kind of go map this trade out. Let's go to the Trade tab. So right now, this is what a covered call is. So this is our example strategy. It's a covered call. And it consists of 2 trades related. First of all, we own 100 shares. And right now they're trading at about 350. I'm going to do a little bit of rounding, if you'll forgive me. Basically 353 bucks a share. I know it's 352 and change. I rounded a few pennies just to make the math simple. Now, we're also going to get into a second element of the trade that creates the covered call. And that is for a period of time. And how about we look at initially, how about we go out here to the 17th of July? 17th of July, so we're just on the Trade tab. We've typed in our symbol and we're going down to what's known as the option chain area. Look at the 17th of July of 2026. So these are 18-day contracts for the potential exchange of 100 shares of stock. That's what all of this stuff means. And how about with the stock trading at 353, we think it might go to 375. What if we were to look at selling a strike price of 370? Oh, I need a little bit more. I need a few more strikes here. How about we crank this up to 30? So right now it's showing 20 individual options that we can get into. Let's do 30. This allows me to go up in price a little bit. All right. So the 375 strike price for call options right now is trading between 315 and 330. Let's say that we consider selling the 17th of July 375 call for, what did I say? About 320. That's the deal. Now, if you're not familiar with this sort of a contract, an option, whether a call or a put, is a contract between two market participants. So just imagine, maybe it's just me and you, if it's helpful. Just put yourselves in the shoes of that covered call trader. So what might be happening here is that, hey, Cameron there is paying me, or pardon me, yeah, I'm accepting a payment, maybe let's phrase it that way, of $3.20 per share. On 100 shares, that's $320 that Cameron is paying for something. What's the deal that Cameron gets? Well, you own shares at $353 per share, and you're agreeing to sell those to me for $375 if I choose to at any time between now and the 17th of July. In exchange for that right, so I would have the right to buy those shares from you for $375. In exchange, I'm paying you $3.20 per share for that right. That's the deal. All right. So for someone who's motivated by income, hey, $320 might not sound too bad. Just be aware there's a trade-off here. We're getting ourselves into a contract, collecting an income, potentially of $320 in this example, but in exchange, we have a contractual obligation for the length of time that we're in this contract. Might have to sell those shares for $375. All right. Now, obviously, for an income trader, this may be the motivation. All right, I get $320 that I didn't otherwise get. There's potential for income there. I always say potential because we might go ahead and make other decisions that cost us this income somewhere down the line. But for right now, we're putting $320 in the account, setting commissions aside. Right? There'd be a 65-cent commission on this trade, so it might be $319.35 instead of $320. But we're just doing the round numbers. But as motivated as we are by income, maybe our trader would prefer, you know what, I really don't want to have to sell these shares, even if it's for $375. I prefer to not get called out. That's what we call it when we sell into a contract where someone has the right to buy our shares and then they buy those shares. We say, oh, they called us out, because in the old days this was done over the phone and they called and required those shares, and those shares were taken out of the portfolio, and of course we were paid for those shares back in the day, called out. All right. Well, how can we reduce that risk? And really, there are 5 steps that might be taken, each of which have an impact on the likelihood of getting called out. And if the trader is trying to minimize that likelihood, these have a positive impact on that likelihood, but there's a trade-off for each one as well. So what are some things that we might do? Well, first thing is, instead of selling the 375 call, we might sell a higher strike price. Another way that we phrase that is going out of the money, or simply, we're requiring that the other party pay us a higher price for our shares. And the higher the price they have to pay for the shares, the less likely it is that they will do just that. So how about, for example, what if instead of selling the 375 call, what if we sold the 380 call? What are we doing here? Well, if we own the shares, we're not getting into a contract where we have to sell the shares for $375. Now, the other trader has to pay us $380 for our share. We've changed the price at which we strike the deal to exchange the shares, but we're requiring a higher price. So we've gone from $375 to $380. Now, if we require someone else to pay us a higher price for those shares, they're not going to pay us as much for that privilege. Instead of getting $3.20, here's the trade-off. We might only get, let's say, $2.35-ish, not $3.35, $2.35. See that right there? The 380 calls are trading between $2.29, $2.42. Let's sort of split the difference and call it $2.35. So there are pros and cons, but the why did this reduce the probability of the other trader choosing to buy the shares? Well, because the stock has to go further up for this to really be worth it for them. Instead of having the right to buy shares for 375, they have the right now to buy those shares for 380, which is a little bit higher up the chart. And if the stock is not worth 380, they are unlikely. They still have the right to if they want to, but they're unlikely to buy those shares. So that's step number one. First step that might be taken to reduce the probability of getting called out is to sell a higher strike. And by the way, we can even see the likelihood of assignment. Those of you a little bit more familiar with options trading and with covered calls specifically, and even just options in general, you can actually see pretty precise percentage likelihood that we ultimately get called out by using a metric that is displayed right here on the screen. Where is that? Well, if we look at the 375 call, we can look over here at this column that's titled Delta. Now, Delta can tell us a couple of things. It can tell us how much we might make or lose if the stock price goes up or down $1 on our option position, how much the option position might change in value. But another thing it can do is tell us the probability of the contract being in the money at expiration, ultimately being assigned at expiration. Now that delta, if we look at this 375 strike, we see a delta of 22. One way that some traders will look at that is, okay, so there's about a 22% chance that the stock is above 375 at expiration on the 17th of July. In other words, there's about a 22% chance of assignment at expiration. If we go to 380, now the stock has to do more work to get above 380. It's easier to get above 375 than it is to get above 380. There's only about a 17% chance that the 380 contract, well, the stock is above 380 and that 380 contract is assigned at expiration. Right? So yeah, there's a direct mathematical impact on the probability of assignment by selling a higher strike price, with the trade-off being lower premium. That's usually the trade-off. You're going to see a common thread running through a lot of these. The higher premium that we're collecting or retaining, the higher the risk of assignment. All right, so what's a second step that we might do? Well, we might choose to sell a shorter term contract. If we're giving this 18 days, let's go back to 375. 375, I'll go back to my original assumption of $3.20 collected. So we're giving this 18 days through the 17th of July to try to climb above 375. Again, just because we're below 375 doesn't mean that someone's not going to call us out. But if they do, they still have to pay us 375. So they'd just be overpaying for the shares if they chose to do that. Anyway, so a second step that might be taken is to not give them 18 days. It's to sell less time on the contract. Let's maybe, how much can let's cut our time basically in half. Let's go to, yeah, it's actually exactly in half. Let's go to this weekly contract expiring on the 8th of July, just after that long holiday weekend. Let's open that up. And if we look at the 375 strike, what's the probability of that being assigned? So for the 17 or the 18-day contract, we are looking at about a 22% chance of assignment. Well, if we give this less time to do its climbing up to 375, there's a lower probability that it gets there. There's only a 12% likelihood of assignment. Great. All right, so we've just dialed down the risk of assignment, except there's a trade-off. If we're lowering that risk of assignment, if we're giving that other trader less time to actually make profit from their investment in our position, what do we get paid? It's a lower premium. Yeah, we're not going to get $3.20. We're going to get paid less. That's the trade-off. There are pros and cons. I know if somebody wants me to wave my magic wand and say, Cameron, show me a way that I can dial up my premium with a covered call and also lower the risk of assignment. I'm going to say, okay, well, actually, I have that wand. I'm going to show it to you in just a moment. But I think this one's fairly intuitive. Give it less time to get to where we think it's going to go, or to where we're trying to avoid having it go, basically. Third step. This is where it's a little bit counterintuitive, and that is sell more time. Cameron, didn't you just say that if you give a stock more time to move, it can make it there more, well, it has a higher probability of getting there? Yes. But if we sell more time, what if we went out from 18 days and we change this up? How about we double it? Let's go out here to the 39-day contract, the 7th of August. That actually, if we look at the 375 contract, and we look over that delta, this saying, Cameron, wait a minute, you just did the opposite of what we intended. There's now a 35% probability of being above 375 at expiration and ultimately having the shares called, if not before. Well, one big benefit of doing that is there's a much larger premium, but premium isn't what we were talking about. We were trying to reduce the probability of assignment. Well, here's how we might accomplish that. Even if we've sold longer term contracts, what might we do? Well, we might take step number one and go further out in time. Let's do this. Let's go further, not further out in time. Go to a higher strike price. What if we sold, let's say, the 395 strike price? That's up here on our chart. Let me draw in a line up here. 395 is up here. And even if we push this out, by the way, I've been drawing these lines. I drew that line to the wrong expiration. Let's activate that drawing and pull it back to July. There we go. There we are. Anyway, but let's make this one our 395 strike. But we're going to push it out and give it more time. So we've given it more time, but we've gone further out. We've gone further up on our strike price. It's sort of a combination of these variables. And we're actually looking at a pretty much identical probability. So we do have a higher premium, but about the same probability of assignment as this original trade. So how did giving us more time reduce the assignment risk? Well, it comes in this case, it's not just the upfront plan of where we do sell our strike, it's how we manage the trade from there. And the plan here is going to look for any opportunity. If there's a drop in the price of the call contract, which means quite literally, if there's a drop in the stock, or maybe just if there's a passage of time, we're going to take an opportunity to try to close that out before expiration. All right. So if we sell this call, even though it's a 39-day contract, if it comes to be day 10 or day 15 or day 20, and we notice, oh, the stock has pulled down a bit, and we can close out this trade for, let's say, 50 cents on the dollar, maybe 20 cents on the dollar, that proactive plan can introduce additional risk reduction, because we're now shortening the length of time that we're in the contract. Now, we may not get the opportunity, but we're planning that if the opportunity presents itself, we're going to grab some faster profits if they're there. So that's it. So step 3 is to sell more time, but then I'm going to move that out to step 4, which is to exit early if the value of the call falls. Now, we don't have to do that only on the ones where we've sold more time. Even on the shorter term contracts, if the stock pulls back, calls get less expensive, time has gone by, maybe there's that chance to close out that call option before having to wait all the way to expiration. And each time we close out a call option, what that does is it at that moment reduces the risk of early assignment, not a little bit, but all the way to 0. Right? So let's do a quick recap for 5 ways to reduce the odds of getting called out. Number 1, sell further out of the money. Number 2, sell less time. Number 3, maybe sell more time, further out of the money, with a plan to close early if we can. And then finally, number 5 is to if this trade just isn't cooperating and we're no longer trying to lock in profits, instead we may be taking some losses, but we're just trying to avoid assignment. If the contract goes in the money, that raises the risk of assignment. For some people, they start sweating. It's uncomfortable, especially if they didn't want to sell the shares. Time to close. It may be time to close that profit, that trade out. Well, it looks like I was going to try to answer a question that's come through in the sidebar discussion in the chat, but it looks like that's just sort of chat back and forth between attendees, which I think is fabulous. So that's great. But let's map out this scenario. Here's where the stock is right now. Let's just go right back. Let's clean up our other hypotheticals. Let's remove this drawing. Let's remove this drawing. And let's just say that we sell a call at 375 and we take it out 18 days to that July 17th expiration right there. Okay. Let me edit that so it's exactly 375. Just gives us a visual reference point. So there's our call. And what we might be hoping for is if the stock does go up, oh, I didn't mean to draw another horizontal line. But if our stock goes up, we're kind of hoping that maybe it just stays below 375. That keeps assignment risk low all by itself. Now, out of the money contracts that are, when the stock is still below our strike price, there's still a possibility the contract could be assigned. Assignment risk is never entirely in our control, except for one scenario. All right, I'll mention that at the end. Some of you might be saying, wait a second, I have control over assignment risk as the seller? Yeah, you wait. I'll explain what I'm saying in just a moment. But in any case, as long as the stock stays below 375, assignment risk is comparatively lower than when it goes in the money, when the stock goes above. So let me just remove this drawing, and let's suppose that before our expiration, the stock has gone up above 375. What has just happened with our assignment risk? Well, someone out there has the right to buy our shares for 375. Those shares are now worth more than that, 380, 390, whatever. They now have a discount according to their contract on the stock price. That raises the risk of early assignment. Doesn't mean that they're all going to say, okay, let me buy Cameron shares right away. No. In the majority of those scenarios, that trader decides to either hold on, see if the stock will continue to go up while they don't even have the pressure of share ownership yet. Oh, the stock's doing well. Let me just sit back and see if it'll do even better while I still have this contract to buy the shares at 375. So that's one thing they might do, or they might choose to sell that call to someone else, which doesn't actually impact our position at all. We don't care who's on the other end of the trade. Anyway, but they might choose to assign. And the higher the stock goes before expiration, and the closer it gets to expiration, the higher the probability of early assignment. Now, as long as that hasn't happened, our trader might choose, I haven't been assigned yet. I'm starting to get really nervous. Maybe I'll just buy this call back. I originally sold it and collected 320. It might cost me more. It could cost substantially more than 320 to buy out of that contract. But if we're able to do that, then that just means we no longer have the obligation to sell the shares at 375. The risk of assignment is eliminated, and we retain ownership of the shares. So there are 5 ways that we might reduce the risk, reduce the odds of assignment. Sell further out of the money, sell less time, sell more time out of the money, plan to exit early if we can. In any case, exit early if the price of the call falls, or exit if the contract starts to go in the money. And the deeper the money, maybe the more urgent the exit need, or the closer we get to expiration while in the money, maybe the more urgent the need to exit. So there are your 5, but I want to throw out a couple of bonus thoughts here. Number 1 is there's something that can come in here and mess up these probabilities. It can actually cause the stock to move rapidly, either up and really elevate the risk of early assignment pretty quickly, or if the stock drops, it can cause the stock to drop and actually lower that risk. That is earnings. Let me come up here. I'm going to change my chart settings because some of you may have been thinking to yourselves, yeah, Cameron, going from July out to August is fine, but there's an earnings announcement approaching. Let me go to the equities tab here, and I'm going to show corporate actions. Those are like stock splits and dividends and earnings. Let me click apply and click OK. And you see this little question mark. That means there's an earnings announcement approaching on July 23rd. So if we're contemplating selling the August contracts, what we have to be prepared for is this earnings. Could it cause price to spike unexpectedly, throw this deeper in the money, and quickly elevate the assignment risk? Yeah. For some, they may look at this earnings announcement and say, you know what? Nope, I'm going to stick with July. I can just sort of sidestep this. Now, theoretically, the earnings announcement doesn't change our probabilities for August. It's already built in because it's sort of a 50-50 thing. Could go up, could go down. One increases probability, one decreases probability. So it's sort of a wash conceptually. That doesn't mean it can't just, with a big, strong earnings announcement, push this thing immediately in the money and really increase that risk at that point. Now, there's something else. Yes, earnings is a sort of a bonus I wanted to throw in here. But I'm guessing there are some of you saying, hey, Cameron, no, I have a different risk mitigation technique that I use, and you missed it. Cameron, you blew it. And that might be, somebody might look at charts to try to mitigate that risk. So let me just remove some of these drawings. Remove this one. Let me remove this one. Get rid of that one. Get rid of that one. Let's just say that our trader, let me extend this to the right. So we have this apparent resistance. Actually, I'll extend it to left as well. Oops, didn't want to draw another line. Right click here. Let's extend that to left. But they might be saying to themselves, well, I've done some hard work by looking at the chart already, and I think I can sell the 370 that we shouldn't go above 375. Well, that's one interpretation of a chart. Here's the thing about charting. Does it actually mathematically change probabilities? No, it doesn't. Nope. Now, if the individual trader is particularly adept, maybe in their circumstances, they might feel like they're moving the probabilities. But this is not one that I could say, this will change in a mathematical way the probability of assignment. Right? Yeah, Mark is saying there are resistance levels here, there are resistance levels there. Resistance levels or price ceilings are interesting. Don't theoretically change the mathematical probabilities. That's why they're not part of the formula in generating delta and other probability metrics. Now, finally, I said earlier, there are circumstances where we can actually be in control of whether assignment ever happens or not. There is, yeah. There's one circumstance where I can say, yep, no chance that we're going to get assigned. And that is we don't do the covered call in the first place. If the trader really, really doesn't ever want to sell their shares, covered calls should not probably play a role in that with that position. Because once we sell the contract, we're not in control of whether the other party decides on a moment to exercise that contract. It actually is randomized. We just don't know. We can try to mitigate our risks. We can take steps that reduce probability, but even with the steps that I provided, we haven't reduced that probability to zero because we're in a covered call that obligates us to sell our shares at someone else's discretion. All right, guys, let's go ahead and place our trade. I'm just going to go ahead with the 375, I think. Let's go to the July 17th contract, the 18-day contract. Let's go to the 375 strike. Looks like might not be able to quite get 320 out of this. It's still a 22% probability, but we might have to settle for something like 315. Let's see if we can get a quick 315 fill. We're going to attempt to sell one of these Alphabet 17th of July 375 call contracts. Let's see if we can get $3.15. We're going to say that's our limit, so least we'll accept. Anytime we use a limit order, there's a risk the order might not fill at all. So trying to get 315 bucks. We'll see. This says there's a max loss that's infinite. That would be true if this were a naked call. This is a covered call because we already own the shares. There is a commission to be paid, 65 cents, that might be chipped out of this, leaving us with a minimum acceptable credit of 314.35 for this example. And let's send that order off and sold it. Now look at that for 315. All right, everybody. We have accomplished what I set out to do today. I wanted to talk to those traders who are selling covered calls, but they're trying to mitigate assignment risk where possible. And we talked through 5 steps that might be taken to reduce the odds of assignment. Again, none of those steps, except for exiting the call, eliminates the probability of assignment. Even when we're thinking we're going to exit under certain conditions, the assignment could happen before we choose to exit. That's not in our control. All right, but thanks for giving me your time today, everyone. I'm going to let you go enjoy the rest of our webcast. There's no Liz Ann Live next, so you get a little bit of a break. But I would suggest if you are new here or if you haven't yet subscribed to our channel, please do that. It's a great resource, our YouTube channel. That's where you can join these live streams. You can find the archives for previous webcasts. So let's bring that up here. Just do a quick recap there. So on YouTube, the channel you're looking for is Trader Talks Schwab Coaching Webcasts. You can subscribe just by clicking the subscribe button right down below the video stream right now. It only takes a second, doesn't cost anything to do that. But this is where you can find the live streams. You can also find the playlists. So to find the playlist for this webcast series, you click on playlists, scroll down through all of these, and what you're looking for is covered calls and short puts. So it's going to take a little bit of scrolling. It's kind of more down toward the bottom. Off to the right here is covered calls and short puts. You just click on view full playlist. And here's last week's discussion. Planning and placing your first exit order on a covered call. Hey, Mark and Jackson, you're welcome. Tony, very much my pleasure. Suggestion that Barb and I would have for everyone watching is also, in addition to watching our webcasts, make sure that you're following your favorite Schwab presenters on social media. You can find us on X. You can find us on LinkedIn. You can find Barb and me on X. Go to @BarbArmstrongCS. That's her handle there. You can find me on X @CameronMayCS. And if you reply to one of my posts on X, I just try to reply right back to you. And so it allows for communication when the live stream isn't underway. You can also find and follow me on LinkedIn. Just go to linkedin.com/in/CameronMayCS. There's my handle right there /CameronMayCS. Give me a follow here. And if you reply to one of my posts, like this video that I just posted about erasing trades from our paper money accounts, I just try to reply right back to you. All right. Barb, thanks for helping out in chat. I don't believe I saw a survey because Barb always does an excellent job of reposting those, and I don't see one. Yep. But in any case, if you ever see a survey, if you do fill it out, that's always appreciated. Thanks, everyone, for all the thumbs up. Over 100 people watching the live stream right now, and we have, as I click refresh on my browser, almost half, 46 people have already clicked the thumbs up. Thank you for doing that. That's very much appreciated. It always is a nice pat on the back for your presenter, and it gives my video a little boost in the YouTube algorithm, helps more people find these discussions. So thanks for doing that, everybody. I will see you in a future webcast. I'll also look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.